Okay, do you see the screen now? So this for IAS2 inventory.
Yes, Nitish.
Okay.
Yeah, we can see.
All right. So inventory accounting in nature and the treatment is very similar to IAS 16, property, plant, and equipment. And it recognizes the expense, any write down or derecognition in a similar fashion, like property, plant, and equipment. In terms of the scope, it has certain limitations. Like it does not apply to construction contracts, because construction is again or any real estate items are long term, whereas the inventory are short term assets. Financial instrument IS 39 ones, which is investment trading products, which are different from inventory accounting, and that's quite logical, because inventory is something to is made to sell in the market, whereas the financial instruments are invested to either make profit or hedge the investments. Hence, IS 39 will not be applicable. Biological assets related to agricultural activity, which falls under IS 41, is again outside the scope.
What is the UMS, Nidhi? UMS2?
Which one?
After scope heading is the UMS2 applies to all the inventories except UMS.
Yeah, these are sub clause. I think in IS2 standards. So there are various like IFRS use some acronyms, but the scope wise this exclude all three standards. So UMS2, this inventory management accounting applies to all the inventory except all these three items, which is part of other standards. What are inventories? So definition wise, something which is held for sale in the ordinary course of business, not for the investment, not for the real estate, because the real estate is the long-term investment. In the process of production for such sale, so if somebody is trying to prepare something, any goods and stock for the immediate sale, or in the form of material or supplies to be consumed in the production process for the services. So overall, any goods in the which is in progress. Key highlights of IS2. So this is again highlighting the age-old rule of the IS2. It should be lower of the cost and net realizable value. So the paragraph 9 of IS2 provides that trendy rule. Net realizable value is again very similar to IS 16, that compares what is the estimated selling price. So that will be, of course, the selling price or the fair market value minus any business expenses, business relay, or transportation cost. All this will be adjusted from the selling price. So when net realizable value is calculated, take the selling price, make the adjustments, and then compare that with cost of then compare that with the traditional cost, or the cost minus depreciation. So whatever the two number is lower, that is considered as the inventory cost. So again, very similar to PPE. IS2 allows a choice of determining the cost. So here it is talking about the FIFO, LIFO, and weighted average methodology. US GAAP traditionally has, I mean, even now, US GAAP has allowed LIFO method of inventory accounting, but IS2 do not permit that. One reason could be actually is that last in, first out basically just exaggerate the cost of the goods, because in reality, when there is any stock in any business and there is a sale, it is considered that the first stock which was bought should be sold first. Why somebody will sell the latest one and keep the old stock? So the FIFO is, or weighted average, is only permitted in IAS 2. LIFO is not. So the difference of NRV and fair value: net realizable value is selling price minus all the cost of bringing the equipment to the working condition or to any given platform. Whereas fair value does not make any adjustment. It is just that notional value or the face value at which two willing and knowledgeable party will exchange the goods. So any price at which the goods can be sold in the market, in open market, in transparent market, that is a fair value. But net realizable value is actually something that makes all the adjustment. Hence, fair value is quite likely to be higher than NRV all the time. Maximum fair value could be equal to NRV, but very likely it will be more than NRV. Back to cost and valuation. Inventory shall be measured at the lower of cost and NRV. Cost of inventory shall comprise all cost of purchase. So this is similar to, again, concept of capitalization for PPE or inventory. We are talking about here what should it be included in the cost. So the cost of purchase, cost of conversion, like making the inventory or any such item ready to be used, and other cost incurred in bringing the inventory to their present location and condition. So transportation cost. This will be capitalized for inventory. Cost should also include A, cost of purchase, including tax, transport, and handling, net of trade discount received. B, cost of conversion, and the cost of bringing the inventory to the present location and condition. So virtually all the cost will be included. Indeed, here also any advisory or any expenses which relates to now finding out where the inventory items will be available, or any raw materials. If one try to find out the details and it incurs some cost, how to find those raw material, those costs are not added in the inventory cost. It is only something that is directly consumed in the product. Any knowledge or any data, any information that is used to find out the inventory supplies, that is not considered for the capitalization. Again, this is similar to PPE, because if somebody advise you and charge a fees to find out PPE or build a PPE, that is also not added in PPE, similar to that. Inventory cost should not include abnormal waste, storage cost, or administrative overheads related to production. Do you all agree? The last point, that could be a little controversial.
Nidish, in this one, like if we have any product, like we are putting some kind of expenses to maintain it. Otherwise, like say any inventory which is required something, so that should be to maintain or keeping it in running conditions.
Okay.
So if we incur any expenses, that should be part of expense only, or do we I think not required to capitalize, right, as you mentioned.
Yeah, exactly. So that's the point of the last one, that it should not be included in the inventory cost, no matter how much cost is incurred. Because take the perspective of a customer, right? It could be the wastage or administrative issue if the stock is waiting in the storeroom for a long time. It does not kind of contribute to the actual inventory, because in the when the inventory is talked about, whatever the raw material is used, the process or the electricity is consumed to build that inventory, that is only considered as part of the inventory cost. Anything that is required to maintain that, actually it is not going to improve the inventory's quality. So that's how, if you think, it makes sense that anything that improves the quality of the inventory, like you buy the raw material, you spend the labor, skill, and then factory machines, electricity, it improves the quality of inventory. But just keeping it somewhere does not improve. It is just because it was not sold, you have to keep it, and then expenses incurred. Otherwise, it could have been sold. So the price of inventory or the cost of inventory only considered how much money you have to spend to bring or make the inventory ready. Anything after that point is not cost of inventory. So write off all such expenses. Cost and valuation continued. The standard cost and retail methods may be used for the measurement of cost, provided that the results approximate actual cost. Is that something familiar? So it is really saying that when it comes to the costing and as a source of the costing data, the retail methodology should be used. Because remember, when we choose to price inventory, even the source data for that cost can make a difference. If you choose a wholesale method or if you buy it from a wholesale, that inventory value can be different from the retail methods. The second point is talking about the consistency, that the same cost formula should be used for all inventories with similar characteristics. For example, we cannot use different cost formula because there are activity-based costing, there is absorption costing, various overhead costing methodologies are there, or throughput costing. So you cannot apply different costing methodology for the inventory which are of similar nature. Especially in the same company, similar inventories, same nature of inventory, we cannot apply different costing methods because it will give different results. And if it can give different results, if it is not consistent, the value is unreliable. The cost number is unreliable, and it can be used for manipulating the inventory cost. Hence, one single cost formula is used across all the inventories of similar nature. Only if it has different characteristics, of course, then different costing formula can be utilized. Any write down to NRV should be recognized as an expense in the period in which the write down occurs. Again, if we are talking about the NRV, we need to go back and revisit the formula, right? So write down to NRV is considered as expense. So essentially it is the loss in the period. And why we write down to NRV? Because the cost of buying something could be $100 this year, and there could be some some loss due to the changes in market. One thing that we need to also notice: do we depreciate inventory?
No.
No. But inventory is ready, right? As per the yesterday's slide, IAS 16, we don't depreciate something which is work in progress, like real estate construction. But if the inventory is ready, then still why don't we depreciate that? I think that will be an interesting conceptual question, because inventory, just like any finished good, it is ready. All the investment is already done, right? Capitalization is also done. Nothing pending. And like any other asset, it can depreciate as well. But anyway, that is a question to think.
Is it like something, the PP, that is the fixed assets for any of the company, we are depreciating, but if the production is something like which we are purchasing and selling as a WIP, then I think that is not a part of a PEP. That is moreover like a production part. So that is the reason we are not doing the depreciation.
So the production part means what? It is.
Let let's just take an example, like if we have a furniture company, okay, so the furniture company, if I bought something any of the machine and something, that should be depreciated, and I will do it also. And if any furniture which is using for my office purpose, and that is the things I'm doing the depreciation. But if any of the inventory to making a furniture or something like that, and I'm using for a selling purposes, then I don't think so. It will be a part of a depreciation. It will be fall in the depreciation definition.
All right. Yeah, that's quite right reason, because we tend to depreciate something that we intend to keep for long term. And one of the prime example is like any property plant or such asset, or even the bonds, even in the investment category, the bonds is one of the asset that is held for long term. So when something is held for long term, that is depreciated, because then you can categorize the estimated reasonable or actually the useful life, right? In case of inventory, if we were to depreciate, we cannot figure out what is the estimated useful life within the company to depreciate that. And also we are not going to use it for long, keep it for long, hence the depreciation is not done. It is just we try to check regularly how much it will be sold in the market for. And that's why the net realizable value comes in picture, because we need to keep checking what is the selling price for this product, NRV, minus any adjustment, because ultimately that's what you are going to get and save. Selling price minus any cost to sell, that is the net realizable value. If that dollar value or INR value, net realizable value, is less than the cost, then it makes sense that we kind of book a expense down to NRV. So cost minus NRV, that becomes an expense, because ultimately we can carry something on the higher cost, but that could reflect an inefficiency, because often in the manufacturing process, if the process is not very efficient, the cost of manufacturing will be much higher than the net realizable value, right? And that is an indication that the process is not efficient. But it is quite possible that cost is quite high, but the net realizable value is quite low. That delta, the difference, will be booked as expense. And this is what it is saying here. Any write down to NRV should be recognized as an expense in the period in which write down is done. Cost of purchase, everything is included, not only the actually the MRP in the shop, but also all the tax, transport, handling charges, everything, because the rule is quite consistent here, just like IAS 16. Any INR you pay to the store plus all the expenses that is incurred, including tax, to bring something to your station, to your manufacturing plant, this is all part of the cost. And of course, if there is a discount, that means you did not pay that much dollar or INR. So that discount is also deducted. So the net amount which you pay to the storeroom, and then whatever expense is incurred to bring that stock to the floor, everything is considered, plus the processing, all the expenses to process that goods to make the inventory, that is also considered as part of the cost. Then cost of conversion. The cost of conversion of inventories. So what would be the conversion here? What do we mean by conversion?
Ready to use.
Sorry?
Any any inventories for it's like direct labor cost. Like whenever we have a raw material and we are preparing the that material for ready to use. So whatever we are giving the cost, incur the cost, that is the cost, cost of conversion.
Yeah, you got it. Yeah. So this is the term that is used in the objective, but it is confusing because the conversion seems something else. But it is really that when you buy the raw material and it is ready. So processing of that raw material to make the final good ready to sell, that is the cost of conversion. So actually, I have already talked about this, that if you buy something, all the transport handling cost is capitalized, plus any skill set, the labor force or the electricity factory cost, which is required to make the product ready, that is also capitalized. So most of the these things are just capitalized for inventory. It will be an easy one if it comes as a numerical. You can capitalize most of these expenses except for any consultancy charges or anything which was done, which was incurred before you bought the raw materials. Cost item excluded from the cost of inventories. Wasted material, labor, and other production cost. Storage costs, unless those who are necessary in the production process, so hardly any. All the storage costs are unnecessary. Administrative overheads, selling cost, why they are not included? Isn't that for the business only, all the admin overheads?
It is not directly related to the production. This is the indirect cost, so that is the reason.
Yeah, but then who is going to pay that indirect cost? Ultimately, is it not for the sale of the goods of the same company, and a pro rata can be allocated? So if you're selling 100 camera in a month, and you are manufacturing those 100 cameras, and your admin overheads are $100, right? If we use activity based costing, the question could be, especially if you go into some very detailed lengthy numericals, the question could be that why $100 of your administrative cost should not be allocated to the 100 camera that you manufactured and sold this month? What would be the rationale? You can allocate those costs, right? Even though it is indirect. The cost allocation is not a problem. It can be allocated. You can choose a costing method like activity-based costing to allocate those costs. Same goes for selling cost. You are selling the same product, yet it is not included in the cost of inventory. The same rule goes for this as well. It is not improving the quality of the inventory. Anything that does not improve the quality of the inventory, that is not part of the capitalized cost. The storage cost is also not included. In fact, there was some revision even to IAS 2, and that has updated few things. It is good to note what are the updates on IAS 2. IAS 2 does not permit exchange differences. So what are we talking about here? Imagine a situation, okay, that you are manufacturing something. Say you are manufacturing a plane, Boeing, And it requires devices from almost all over the world. There are various navigation devices, and it was brought to India, and the entire Boeing was manufactured, right? For any Boeing company, basically the planes are inventories. You make it and keep it ready for sale. So here Boeing plane is the inventory. So all the devices were used from foreign countries, and the entire plane was built. The plane is not sold for 3 months because the corona, spread it. Now the question is, if you really look at a component which is coming from various countries, and imagine that Indian currency is going down, okay? If the Indian currency is going down, then the value of the each component is going up. Agree?
Yeah.
If the value of each component is going up in the market, then does that make sense that we revalue and kind of update the value of the entire inventory? Because ultimately, if I was going to build that in same Boeing today, buying the inventory and the component from various countries in the foreign currency, and knowing that our INR is reducing, getting weaker, then the price of the same Boeing will be higher now, right? It's just a maybe coincidence that 2 months later, earlier, I made that Boeing plane, but if we were to build the same Boeing plane now, it will be much more expensive. So the question is that why that should not be factored in the cost of inventory if the FX is contributing to the increase or change in price. How would you defend this? I know IAS2 says that, okay, it does not permit, but why? Why would you defend? How do you defend this?
So this, it would be the same logic what you have mentioned, that it's not added any in the value of the investment, and like it will not, we are not considering into the cost of the inventory. But if I didn't do any kind of adjustment or any kind of a hedging on that, so if whenever there's a need to make a payment, so I need to book a losses on that, and it should be part of other comprehensive income. But the cost what I have mentioned, the agreement or contract what I have mentioned, I need to be take it on that. It should not be, it will not be included in the cost of, it will not be increase or
Yeah, it is not improving the quality, but don't you agree that if we were to build the same plane in earlier question, basically your storage expenses are not included in the inventory, but because it is not increasing the quality, and even if you were to build it now, it will almost price the same. But now the price of building the same Boeing is going to be higher now. If you take any market-based approach, it is more expensive to build it now. It was built 2 years ago, or maybe 2 months ago, and now it is almost $500,000 more expensive, yet it is not considered. The reasons are that there is a separate way, foreign exchange accounting in IAS 21, and that has a different way of accounting, and it does not really include the inventory impact for FX. So there's a different accounting standard to account for the FX differences, IAS 21, and that do not even include the inventories. Because one of the reasons that could be that inventories are again not an asset which is invested for the long-term gain or loss. It is just prepared to sell immediately. Second thing is that if the FX is going to be considered for such inventory, the calculation very likely is going to be very complex and subjective, right? Because there are so many different components, whether to take the average price or you take the last price. There are so many different considerations, because you remember the basically the manufacturing of the plane would not have done in a single day. It could have taken almost a year. And then the question would come up that which price to take, the average price of that 1 year for foreign currency or the end price. So there are way too much of complication, and it is subjective. Hence, IAS 2 does not permit the FX differences. Because when we'll go into the foreign currency, we will see that there are like a wide varieties of the rates which is applicable as well. And for inventory kind of things, it is too cumbersome, but does not add much value.
So Nidhi, means we should take the average price, right? In this case.
No, the average price not, because there is a two method which is described in IAS 21, temporal and historical price, because it really depends when the most of the components were bought. And if we take the average price, then again the prices which are in different currencies, that will be subject to inflation. Now there is a separate standard for inflation accounting. So I know it soon sounds kind of very convenient as well that we take average price for the duration and apply it, but that is also not going to be very accurate, because we don't know when most of the components were bought. There could be like components were bought in one particular month. So it is just not used because of all these open questions. So even if you apply the FX standards as per IAS 21, basically that is applicable for the inventory, which is a final, which has a final date. Something which is in progress, it does not go into that detail. It just takes the last date and value everything, translate entire book using one foreign currency. So depending on the line item, the historical or average rate is applicable. So if the dividend is distributed, then it attracts the average price. If you are translating the inventory, that will be on the historical price. So there are different FX price permitted to translate the entire balance sheet. Balance sheet translated, and then P&L is also translated. Most of the P&L items are taken on the average, because the sales of the goods and services is considered to happen throughout the year, on average basis. So that attracts the average price. Balance sheet normally attracts the historical price, and then there is a FX difference adjustment made in the comprehensive income. So that's another interesting one.
Yeah, because normally I have seen in the SAP tool, uh, they have not such kind of option. They have an option. We should take the average price. Like the person, any one person can update the FX price on a daily basis, and the end of the quarter or end of the annual, whatever the policy they are following, they should take as a average. That's what my I'm asking. Like, is there any clause mentioned in the standard also? Because whenever we are going to in the implementation stage, we need to find out one common solution, right? Because it cannot be possible on daily basis or the last rate we need to take
Oh,
the foreign rate.
right. So what I'm suggesting is you have four different statements. So balance sheet and the P&L. Okay. So when we talk about the P&L, so the revenue is there. Revenue would have been spread across 365 days. So at for that, we don't take the revenue of each day and multiply by the FX for that day. That is too cumbersome. How the FX translation happens is you take the entire year's revenue, 2 million, then you take the entire year's FX, average FX, and then you translate. So that's the meaning of translating at the average price. So P&L is translated at the average because it is considered to flow equally throughout the year. But the balance sheet item, with exception to certain items like equity, etc., balance sheet items are converted into the historical using historical price. Because why? Balance sheet is prepared as of date, right? Even on the header of the balance sheet, it says as of this date. So whatever the asset is still there, we convert using the one single date price as of the reporting date. P&L is on the average date. But of course, there are some exception in the balance sheet as well, which does not go by the average, like a dividend, etc., payable, etc. The equity stocks value, those have different approach. So yeah, we don't take every day's FX and translate. It will be too cumbersome. Is that what you're asking for? Yeah. So there are like two method, temporal method and current method. So the temporal and current method, which is part of FX translation in IAS 21, it has its own set of rules how to translate which items in the financial statement. So you can choose temporal method or current method. Once you choose one method, then there are rules prescribed how to translate each primary statement and each type of accounts using one particular FX rate. So this is how that goes. So paragraph 18 inserted to clarify that when inventories are purchased with deferred settlement date, the difference between the purchase price for normal credit terms and the amount paid is recognized as interest expense over the period of financing. How do we simplify this? Why it is recognized as interest expense? It sounds like just an admin lag.
It should be the interest expense one. We do not have any other option, right?
But
Let's
why
suppose
is that
uh,
one thing that actually should be, in fact, added in the context, that when there's a deferred settlement terms, the future prices would be higher. Only then you can account this for interest. Because why somebody will give you deferred settlement terms unless there is a compensation for that deferral. It's just like EMI, right?
yeah,
EMI which is not free. So if you pay now, it will be 100, or if you pay in future, then it will be 105. And that $5 of the difference should be considered as an interest, because in a way it is providing you the finance. Now, the next one, the statement does not permit the use of last in first out formula. So we have already covered that one. LIFO is not permitted in IAS framework altogether. Cost formula. Goods or services produced and segregated for a specific project shall be assigned by using specific identification. Do you know what is specific identification? Generally, we don't encounter this, but specific identification is one of the cost allocation methodology. This specify that say in a very specialized industry, whereby in especially kind of a defense or medical devices, each equipment are very specific and very expensive as compared to others. So if you have 5 scanning devices, each scanning device could be made by different manufacturer in different countries with different specifications. Okay, you cannot apply LIFO or FIFO, because what happens with LIFO and FIFO, it does not distinguish one stock from another, right? It just take a sequence and order. So this one permits FIFO, so first in and first out. If something that first was in and was kind of very expensive, that will be still out, and the recent one which is cheap that will be used later on. But on that group, it does not factor whether one device was worth million and another one was just a couple of $100. So what happens as a problem, that for the entire month or for the entire 6 months or year, the costing is not appropriately assigned, because first in first out or LIFO you can use when all the items are almost similar in the cost, right? Do you follow me? When all the items are very similar in the characteristics, very similar in the cost, of course inflation can make the difference, but it will not be generally more than 5 or 10%. But if the items are very specific in nature and one item can be so much different from the other one, you need to assign the cost based on which good was sold. And let's take the example of, again, Boeing. One plane of the Boeing could be much more expensive as compared to other one. Would you still assign a very generic price, average price, or first in first out method? Because it will not give the due credit to the cost of that specific product. In first in first out, you don't remember or you don't keep the record of each specific assets. Everything is bundled together. So specific identification is where you identify each asset with some barcode or asset number and has a specific price for that.
And Nitish, the price would be also high for those specific, because that is the reason why we are not considering as a bundle and all this. It would be a reason, right?
But the price may not be specific. Let's take that situation again, going back to our medical device one. Price of some assets will be high and some could be very low, and because of that fluctuation only, we need to identify specifically each asset, right? One scanning device could be, say, a few $100s if it's a simple ultrasound device. But if there is some PET technology which is used for scanning as well, positron emission technology, that could be $1 million worth of the device, right? Can we use a general method like first in first out for that? The massive difference of the prices will not be properly allocated to the each goods. Generally, first in first out is okay when the goods are very similar in characteristics. Here, a specific identification is used when they are dissimilar, not similar.
Okay.
And not all of them will be expensive as well. It is not that all will be expensive. Some can be very cheap, other can be expensive. But to do a fair accounting with those which is very expensive or very cheap, we need to have specific identification. Then first in first out, so that takes a sequential inventory process, that whatever came early will be considered to be sold first. Somewhere it makes sense, because in that manner, if there is an inflation, we can properly allocate the goods. But in case the inflation is also kind of very cyclical, it can screw up the number, because whatever was the first assigned, sometime it could be too cheap. But when the inflation is rising, then you are selling. It is still a better accounting costing method, because in the rising inflation, you are selling the goods which was bought cheaper earlier, and 10 months later you will be selling the goods which is bought now. It is still much more reasonable. Even the US taxation allows FIFO methods. Weighted average cost formula, as the name suggests, we take the average for the entire duration, average cost, and whatever the unit was sold, we consider that as a sales of good, cost of goods sold, COGS. Entities shall use the same cost formula for all inventories with a similar nature. We have already discussed that one, why it is important to use the similar costing method.
Yeah, Nidhi, I have one doubt here in the slide number 12. even I just wanted to understand like LIFO, FIFO, and weighted average. These are the uh, way of the inventories method, right?
Mhm.
So from this
Costing.
method only we are segregating the all the inventories. So what is the basically difference between specific identification? Of course, we have a multiple items, right? Let's suppose I have a five pen, and they have a different barcode, and based on the barcode and based on the stock is coming from the factory, we are creating the LIFO FIFO method, right?
Mhm.
Like so based on this only I'm selling I'm using the lipo fipo and weighted average. So you have mentioned here the using the specific identification. So I just wanted to understand, is there any difference between the method, the lipo fipo and specific identification? My question is that if I'm using the specific identification also, we need to maintain under this any one of them, whether the lipo method or FIFO method or weighted average method.
No, that is a separate method altogether.
Separate, Pawan. There are three
Because,
methods, four methods. Yeah,
yeah,
specific.
LIFO one, FIFO second, weighted average third, and specific identification fourth. So the example I was giving is, imagine you have a FIFO method, right? So first in and first out. Thereby, you are just clubbing all the 10 devices which was bought in the month of January 2020, and that is sold now. The price and the characteristics of all the devices were similar, and you noted down that 10 goods were sold and each was $100. So 1,000 is quite reasonable. So it's okay because they are all similar and similar price. Now take the another situation. Specific identification is needed where you have a devices which is one could be $2, another can be 200 worth of dollars, right? And that could be bought in the inventory throughout the year, right? So in January you bought something for $2. In June it was for $100. In August it was bought for $200. Okay. When the customer came and customer said that I don't want the $2 one, I don't want even the $10 one, I want the one that you have $200 worth of device, and you sold it. And your accountant is using FIFO method, right? Now tell me what will be the price used, the cost used under FIFO.
Yeah, that is very difficult.
$2, right? January, first in, first out. In January, you bought for 2. You are going to use the costing as at the rate of 2. You sold 10 device times 2. In fact, the customer has bought the device which are worth 200. Are you
Yeah.
allocating right cost?
No.
So that's why the specific identification is needed when all your goods are dissimilar in nature. One
Yeah,
is different from another one.
yeah, I
And
got.
especially for defense, high-end medical equipment industry, or all this can be because the nature of the goods are quite different from each other. Net realizable value, just a formula to calculate this. Estimated selling price minus discount, of course, the final selling price. Then estimated cost of completion, inventory cost, minus the selling cost. So net realizable value. So it's just a tabular format to help calculate. Are we good?
So here we are not including the dismantling charges in the inventory. We need space, we need other storage, and we need.
That could be generally it could be a good thought, we can include, but for inventory, it is not required, because inventory, remember, is one item on the factory, right? And a factory can manufacture millions of such items. The property, plant, and equipment used to have that setup cost or cleanup cost, because one, you can buy only a couple of devices in the factory, but inventory, you don't know how many you are going to manufacture. So for one inventory, it will be very negligible price. So dismantling charges are not relevant for inventory. Yeah, the factory or the machine which is manufacturing that inventory, that will be that will be subject to the dismantling charges. That's one thing. Indirectly, dismantling charges is attributed to inventory. Do you agree?
Yep.
Indirectly. Because when you allocate the absorption costing, if like one machine is manufacturing 1 million of the goods, ultimately those inventory are going to have the impact of all the cost, because the factory is going to manufacture and the cost will be somewhere allocated to each good. But dismantling is only attributed directly to the factory or the machine, not to the each inventory.
Yeah, I'm talking about the same because um, I was remembered that if you taking the example the RMC, the ready mix concrete plant, so they are producing the RMC and giving this service to the all the real estate industries, right? So in that case, they are including that also in the cost. That's what I'm asking.
But that's the real estate relating, right?
Yeah, real estate, but the business is that we are preparing the concrete, like for the building, creating the building and all, right? Cement and sand and all, they mix it and they prepare the one RMC and giving to the service to the all the real estate industries, because the builder doesn't have a space and all for the establishing the RMC plant in the compound. So what they are doing, they are purchasing from outside, from the third party like Ultratrack or some other industries. So they are giving this type of services. So in that case, whenever we are getting the quotation from the uh, the material, they are including this cost also.
That's naturally, that's logical. But so what is your question? Should that dismantling prices be included into each inventory, or you're saying that that should be only allocated to the
Yeah,
machine,
yeah, dismantling charge that should be the include. That is
each
my
inventory or each machine?
yeah, but
So what is your suggestion? At what level it should be allocated? Machine or inventory?
machine.
Yeah, so that we have already discussed in the PPE, that machine will have impact, because when you're capitalizing the cost, we have discussed yesterday that 20 years later, whatever the dismantling charges will be expected, you need to take the present value and allocate that to the machine. But it will not flow down to inventory, because that will be too minuscule, and it will be like thousands or millions of such inventory produced. And even for the real estate context, the rule of thumb is that when you think that dismantling charges is substantial for per unit basis, then it is included. In case of real estate, you're going to make hardly 4 or 5 building in one go, or maybe a couple of hundreds of the houses. It is still practical to allocate one proportion of that dismantling cost, and it is also short term.
Yeah.
If it was like you're going to manufacture to build some thousands of houses in future, then again probably no one will care about those dismantling charges. Provisions for inventory impairment. Okay, so can the inventory be impaired? Can this be impaired without any further discussion? Yeah, because we have earlier noted that there will be a carrying kind of a cost of inventory, and whenever there is a cost, we don't depreciate the inventory, but we do check for what? Net selling price. Net selling price, once we know that one, so generally it is also considered the test. So if you think that the cost is higher than net selling price or NRV, there is a impairment. Okay, once you realize that there is an impairment, then you also find out that what are the other extra charges, the cost which you need to incur before or after selling the good. So selling minus all the transaction cost, the transport cost, etc. So that becomes your net selling price. Compare that with the cost. If the cost is higher, then you have a impairment. The cost minus net realizable value is the impairment. That is an expense. So that's what I think this is talking about. If those inventories are damaged, if they have become wholly or partially obsolete, or if their selling prices have declined, then there's a impairment. The cost of inventory may also not be recoverable if the estimated cost of completion or the estimated cost to be incurred make the sale have increased. The practice of writing inventory down below cost to net realizable value, so yeah, NRV, is consistent with the view that assets should not be carried in excess of amount expected to be realized. All right, yeah, so simply it is underlining the same concept, and it is taking the prudent view that the carrying value should always be lower of all the estimates, whether it is cost or the net realizable value. Take the lower value always for the balance sheet. Disclosures. So what do we disclose in the notes and footnotes? Accounting policies, important. Carrying amount of inventory. So each inventory should be, each type of inventory should be maintained separately. Carrying amount to be written together with the carry amount. Other disclosures should be provided that generally the information that goes on the financial statement will not be too much detailed, but the auditor can still find out the files in order to verify. But in the financial statement, we will not provide the entire calculation and the details, but the backup should be there for the audit. Rest are just the definition, because whenever we have carrying amount, when we do the testing for the whether the carrying amount is still lower than the NRV or not, we need to have the evidence of those testing. We need to have the evidence that the NRV is checked at least annually, so that the company still is correct in carrying that on the carrying value on the balance sheet. The amount of write down, of course, if carrying amount is higher, then there will be write down. So the entire details, the backup, how the NRV is calculated, what is the basis of calculating the selling price, all these will be required. But that is not published in the financial statement. It is again as the backup. But all we need on the financial statement is amount of write down. Then amount of inventory recognized as expense during the period. Why? Because if there is any write down, that will be expense. Also, we need to showcase how much was capitalized during the year, and how much of the expenses on the inventory was related to expense. Basically, because if there is any admin cost or wastage or the charges for the storeroom, etc., that is not going to be capitalized. So that will be reflected as expense. Circumstances or events that lead to the reversal of a write down of inventories. Now, that's the interesting part. So when there is a write down of inventory, that means carrying value was higher than the NRV. there could be a situation when there is a reversal as well. When the reversal happens, so the expense or the impairment which was recognized in the P&L is reversed. In that case, you reinstate or you make a positive entry in the P&L, you make a credit entry to the P&L, for the reversal of write down. That means the inventory has appreciated again. But that is done in a very exceptional basis. First. Second, when you reverse the write down, you cannot go beyond the expense that was recorded earlier. Again, the cap will be to the maximum of the carrying value only. If you were to reverse the write down, you cannot go beyond the carrying value historically. Okay. So that is the rule for reversal, but that is very exceptional. Once you decide to reverse, you need to explain that why the write down is considered to be reversal, what were the business factors at that point of time when the write down was done, what has really changed so significantly that you have to reverse the write down. So there is a detailed disclosure requirement for such situation. Hence, it is generally avoided. It is very hard to prove such back and forth of the number. The carrying amount of inventory placed as security for liability. So if there is anything collateralized, basically. So if the collateralization is done on the foot of the inventories with the bank, those details needs to be provided. Any question?
Nidish, I have one silly question actually. Do we know like how we'll do the accounting of collateralization? We need to really book any entry.
Entry for collateralization, right?
Yeah.
Okay. So let's say you had 100 cameras in the stock, 10, which is $10 value each. So 1,000 worth of inventory of cameras. Now collateralization is you hand over the position of those inventories or the legal ownership to somebody, a bank. Bank will give you $1,000, and bank will be temporarily the owner of those 100 cameras. So what happens that in terms of journal entry, recognize a cash flow. So you got a cash, so debit the cash. Then you also have a liability. So credit the liability of $100. Okay. And what else should be done? You're done a liability, you have a asset. Anything else?
Expenses also need to be.
Which expense? Interest will be there definitely for collateralization. And then in case of collateralization, there is a haircut concept as well. Because whenever you need to get the collateral money, you need to provide extra assets because there is a haircut, 20%, 25%. You need to provide $125 to get the $100.
Should be 102 to 110.
Yeah. So that's a collateralization. Then there's another concept called reverse collateralization. Basically, when you can basically collateralize the asset of someone else, and you take the asset on the loan and collateralize the asset of somebody else. But for the simple collateralization, we make the entry just like a lease. We make an entry for the liability, which is credit, and then recognize the cash as debit, and this is how we fix it.
Okay. Thanks.
Recognition as an expense. When inventories are sold, the carrying amount of those inventories shall be recognized as an expense in the period in which the related revenue is recognized. Okay, simply whenever the revenue is recognized, there is a cost of goods sold, COGS, in order to calculate the gross profit. So though we have been recognizing the cost for the inventory so far, and that cost or the expense is capitalized so that we have inventory value. But when the inventories are sold, all that carrying amount is expensed out, and that is called actually COGS. It's not a pure expense actually. It should be said cost of goods sold. So revenue minus cost of goods sold, the net profit, the gross profit. So that COGS is your carrying amount of the inventories which is sold. Amount of any write down of inventory to net realizable value is an expense that we have noted already. Amount of any reversal of any write down of inventory arising from an increase in net realizable value that we have understood, that there was a camera for $100, then there was a news in the market that government is going to ban the camera because of some security issues maybe. So the price of the camera went down from 100 to 70. So there was a net expense of $30 in the P&L. Then after a few months, there was a news that government is changed and government is going to recognize camera as a valid digital equipment. So the price started to go up again. Now, even though the camera becomes very popular and the market is very good, you cannot reverse more than 30. So you can reverse all the $30 of the write down, which was made into the P&L earlier. So you can recognize a $30 plus or the credit entry into the P&L as the reversal of the write down. But it does not go beyond the carrying amount, which was historically there. Okay. So there's some kind of a revision or definition stuff, that what is the inventory as per IAS 2? Which are the costs that should be included for the measurement of the value of inventory? Which are the costs that we don't include?
A only.
A? No. The question is actually B and C. What are the costs that you include into the value of inventory? It's not MCQ. It's a narrative.
Nitish,
All right.
anything like which you mentioned for the increasing and the working condition or whatever we can say, increase the value, that would be like should be added, and they should be the, we need to do the capitalized, and any cost like which you mentioned like storage and other things related, that should not be capitalized.
Right. How about this? You conducted a research basically to make the inventory processing more efficient, right? You recruited some artificial intelligence expert for 6 months, team of 10 people, to make your inventory making more faster and accurate and precise. And you spent almost $10 million on that. Would you capitalize that in as part of the inventory? Because that was supposed to make the inventory processing faster and more and better, right? When we say better, that means the quality can be improved. So 10 million worth of research and development was done, and it was successful as well. Would you add that to the cost of inventory?
So they share, it will be depend like you, as per what you have mentioned, the consulting phase should not be a part of this one, but we need to be see like with say major expenses put like you mentioned 10 millions, that is a big amount. So in that case we management need to be see, but I think so we should not be include, but I think somewhere like I think about that if it's expenses is too much or a big amount, somewhere we should be think about to be capitalized. Not sure, but yeah.
The process is improved and research was successful. The commercial viability is also established. Hence, that can be capitalized, but not to the inventory. It will be for the machinery overall. All right. So yeah, all the wastage, all the admin selling charges, those things are not capitalized. Do you remember a model called value chain analysis? In the value chain analysis, there was a model considered primary and secondary activity. In any organization, there are primary activities, something called input, operations, selling, etc. So inbound logistic, outbound logistic, these are the process which involves in the selling of goods or services. Then there are the secondary activities like HR, IT, admin. So anything that relates to, in the world of inventory accounting, anything that relates to a secondary activity is not considered as cost. That will be a easy way to remember. Here are 3 questions embedded. We need to calculate what is the fair value of the inventory. Question number A says there is a table costing 1250 pound. This type of table sells for 1895 generally, but it was damaged in the flood and therefore will be sold at discount. Now it is expected to sell for 450. What is the cost of this inventory? And what is the any other number that we should recognize in the primary statement?
Impairment loss of 800.
Okay. And what do you do, what would you do with that impairment loss? What will be the journal entry?
We'll book.
Okay.
Yeah. So impairment loss debit and 450 we will.
You can credit the 800 as well. The one that you're debiting in the P&L, which is your expense cost. You can
Okay, liability, right? 800 impairment loss liability side.
no, not liability. Your inventory is reduced, right?
Assets get reduced.
Yeah, your inventory in a way is reduced, right? Whether you sell
Okay,
it,
so yeah, inventory credit, right, yeah. Oh yeah, got it. Impairment loss debit to inventory, 800.
right? A wardrobe that cost the company 720 are selling for 995. That is also damaged, and there's a cost approximately 120 to repair, and then it can be sold for 750. What is the fair value and expense, etc.? What will be the other relevant journal entry, if any?
Is it like we should book the loss? I need to calculate actually, but like a 720, it should be normally 995. So what may be the my loss over and above? I put it's damaged. That's fine, but I put already 120, so it should be more need to be added in my um, and repair it, and when which one can be 750.
First, you need to look at what is the most irrelevant number.
995.
Yeah,
995. Yeah.
yeah, because that's the one that we can just cross out, because
Yeah.
right now the situation is completely different for that.
And cost should be the 840.
Yeah. Sorry, cost should be 840. No, I'm asking for, okay, the question to focus on. What would be the cost of this wardrobe?
840.
No. Why? And why 840? Because remember, whenever you say it is a cost, I think we are taking a traditional view. In the traditional view, when we say cost, we just keep adding all the expenses, right? Here, cost does not mean that. Here, cost means your capitalized amount, which should be carried forward as the inventory, right? Not all the expenses or the cost which you incur is going to be added. The cost really means something worthwhile, something that adds the value to the inventory, something that you can expect to make money on in the market. Okay. Just to clarify now, you can sell it for how much? Your testing should be like this. How much you can sell it for? 750?
750.
What is your cost of selling? 120?
Yeah.
So 720 minus 750 minus 120? 630?
630.
630 is your NRV, net realizable value.
Yes.
Now, what is your cost of this wardrobe? 720.
7,
Which number is higher, 720 or 630?
720.
Sorry, actually the question should be the other way around. Which one is the lower, 720 or 630? 630 is lower.
630.
Okay. Now, what is the difference between 720 and 630? 90 pound. So you made an expense or loss of 90 pound. The cost of the new cost, actually, net realizable value is 630. So your new cost of the wardrobe is 630. You made an expense to NRV of 90 pound. Is that clear?
NRV should be 600, right? 720 minus 120, right?
No.
750 minus
NRV
130.
is net realizable value, which is selling price minus the.
Okay, 750 minus 120. Okay.
Yeah. Then the third question, C. One nine eight three. What is the fair value or what is the cost of inventory? The selling price 2250 minus cost of commission 105, then delivery minus delivery cost 158, then somewhere around 1983 pound.
1990 should be the cost.
1990.
Yeah, I'm adding 1832 plus
You're
158.
4 5 pound here. Okay. Yeah.
8.
2250 minus 105 minus 158. Are you all having the same number? Any
So
other?
delivery cost also we need to exclude, right?
Yes. So we need to exclude 263 pound.
Yeah, 105, that is fine.
Yeah. Next question. What is the carrying cost of type A, B, and C? Each answer should take 3 seconds. Type A, type B, type C. How do you do that? Do you consider the FIFO or LIFO? Both? One? Which one?
I will consider only FIFO, not a LIFO.
Yeah, LIFO is out of context, right? Now compare the FIFO versus NRV.
Then it should be in the type A it would be A, type B it would be
Yeah,
NRV, and type C it would be
wait.
FIFO.
What is type A? What is your carrying cost for type A?
It's
Fifo,
yeah, FIFO
Okay.
8300. Yeah,
Okay. Type B,
NRV
10,200. NRV.
type C,
will be FIFO.
Fifo, 12,300.
and then you also need to notice that your total should change.
Yeah, total will be changed. I need to
Yeah.
we need to calculate.
This is a writing scenario. You can attempt it.
Okay.
It's kind of a descriptive question that is required, providing the explanation stepwise, but very similar to what we have noted in other question. We need to follow the sequence of what should be added, what should be subtracted. Balance sheet item costed 8,200 pound, but estimated that that could now be sold only for 4,800. So you can see a direct expense actually down to 4,800. The purchase figure includes item to the value of 2,000 which Manoj took for personal use and for gift to friends, right? That is something that is a wastage. Subtract that one. Of course, if you're going to consider the cost. So applying all this together, what will be the inventory valuation as of 30th September?
Is 47,477 because uh, in the first point it mentioned how I included this because let me try. But estimated that could not be sold for only 4. Okay.
47,477 minus 3,400.
Okay, I had reduced 2000. That is sure. And what? How?
44,077 pound, because one of the component which was used in the inventory, right? Inventory cost is historically 49,477, right? You agree? One of the
Yeah.
component, because suppose that somebody has to build it again, how much somebody will build it for? It will be only at the rate of 4,800. They will buy the machinery, and one of the component has depreciated to 4,800. So then there is a loss of 33,400 there. If one component has depreciated, does not it depreciate the overall value?
It would be, yeah.
Because it is all about the net value, right? So that 3,400 is reduced, then 2,000 is reduced. So 5,000, actually, yeah, 5,400 is reduced from 49,477. That means 44,077 pound is the answer. So that's the story of one IS2. Any other question?
Nitish, only a question about like a inventory. Inventory, we understand how the LIFO and the LIFO is anyway it's not working. FIFO and specific the item what you have mentioned, that is fine. But
It's very,
yeah, yeah. But the thing like the valuations, like you mentioned that we should take the selling price and then we need to reduce it. Any specific cost, right? Like we
selling
charge
price
this.
minus admin cost or transport cost, etc. Any transaction cost, which ultimately reduce the money that goes to your pocket, right? This is how you should look at. If you are going to sell something, you sold it, but there you have to pay to somebody else. So ultimately, how much money goes to your pocket if you sell that item? That's the money that you need to look at. That is the net realizable value, because what the word is very important. Realizable value. How much you have realized. The realized value is always lower than the selling price, because whatever the cost you incur to sell that, that is the realizable value. So NRV is often lower than the selling price. Compare that with the carrying amount. Whatever be the lower of the two, that is your cost. Cost.
Okay, Nish, got it. Thank you.
All right, so